Here's a number that surprises almost every retiree the year after they stop working. Cross a single extra dollar of income, and Medicare can charge you an extra $1,000 to $6,000 a year. Not because you earned more, because you tripped a cliff. It's called IRMAA, the Income Related Monthly Adjustment Amount. It doesn't rise the way a tax bracket does, it jumps. $1 over a threshold, and your premium resets higher for the whole year for you and your spouse. Retired teachers, nurses, and federal employees hit this cliff constantly, and most never know it exists. There's a way around it. It's called the ladder. I'm going to walk you through why this cliff exists and how retirees who know about it plan around it years in advance. I'm a researcher with a public administration background. I dig through the actual agency rules and legislation that decide what retirees are owed and what it costs them, and I translate it into plain English. Nobody sits retirees down and explains this. It's not a conspiracy. It's just that the rule lives in Social Security Administration guidance, IRS publications, and Medicare premium tables that don't talk to each other. And no single agency is responsible for warning you before you cross the line. Your financial advisor, if you have one, may not even flag it because IRMAA isn't calculated by a bracket. It's calculated off a number called MAGI, Modified Adjusted Gross Income, pulled from a tax return you filed 2 years earlier. By the end of this, you'll know what that cliff looks like in real numbers, why a single large withdrawal in 1 year can cost you more than spreading it across five, and what the ladder strategy actually means. Not investment advice, just the rule, and how retirees structure their withdrawals around it. This applies whether your retirement income comes from a state teacher pension, a hospital system pension, a federal FERS annuity and TSP, or a mix of Social Security and savings. The IRMAA rule doesn't care which agency your check comes from, only what your MAGI says 2 years back. Before we get into it, if this video helps you better understand how IRMAA and stuff works, take a second to like the video and subscribe. It really helps the channel and lets me keep creating clear, research-backed guides that make these complicated Medicare rules easier to understand. Now, here's the mechanism. Once you turn 65 and enroll in Medicare, your Part B and Part D premiums are no longer flat. The standard amount is what most people pay. But if your MAGI, your adjusted gross income plus tax-exempt interest, crosses a set threshold, you move into a higher IRMAA bracket and you pay a surcharge on top of the standard premium. As of 2025, for a single filer, that first threshold sits at $106,000. For a married couple filing jointly, it's $212,000. Cross it by even $1, and the surcharge applies to your full premium for the full year for both spouses on Medicare. This is not a smooth slope. It's a staircase with 5 or 6 steps, each one significantly steeper than the last. The gap between just under the line and just over the line isn't proportional to the extra dollar you earned. It's a flat jump to the next tier's premium. That's the cliff. Here's where the ladder comes in. Say you retire at 63. You haven't claimed Social Security yet, and you won't take required minimum distributions from your traditional TSP, 401k, or IRA until age 73, thanks to the Secure 2.0 Act schedule. For those years in between, often called the gap years, your taxable income can be unusually low. That's the window. Instead of leaving all that deferred money sitting in a traditional account until age 73, when the IRS forces you to withdraw a large amount all at once, you convert a portion of it to a Roth account each year, on purpose, in controlled slices, while your income is low enough to absorb it without crossing an IRMAA threshold. Let's walk through one real number example. A retired federal employee, single, age 64, has $400,000 in a traditional TSP. Her only income right now is a small FERS annuity of $18,000 a year. She hasn't started Social Security or RMDs. Her MAGI, before any conversion, sits around $20,000. The first IRMAA threshold for a single filer is $106,000. That leaves roughly $86,000 of room before she'd trigger a surcharge. So instead of letting that $400,000 grow untouched until RMDs force a huge taxable withdrawal at 73, one that could push her income well past several IRMAA tiers at once, she converts $80,000 from traditional TSP to Roth TSP this year. She pays ordinary income tax on that $80,000 now, while she's still under the cliff. Next year, she does it again, in another controlled slice, reassessing her room each time. That's the ladder, several planned steps, each one staying under the line, instead of one uncontrolled jump forced by the IRS clock. Now, the exception, and it matters. This does not apply to everyone. If your retirement income is already going to stay low permanently, no pension, modest Social Security only, there may be no cliff to plan around, and converting could create tax you didn't need to pay. If you'll need the converted funds within 5 years, the Roth 5-year rule can create penalties on early withdrawals of converted amounts. And converting itself is income. Do it carelessly, in one oversized step, and you can shove yourself over the very cliff you're trying to avoid. The latter only works if each rung is sized to your actual room under the threshold that year, checked against your specific filing status and your specific state's tax treatment of retirement income, which varies. And it applies unevenly across the four groups this channel covers. A retired teacher drawing a state pension often has less flexibility because the pension itself is fixed and taxable, eating into that room before any conversion decision is even made. A retired nurse whose pension came from a public hospital system may face the same fixed income squeeze, plus a state specific WEP or GPO offset that changes the math further. A federal employee with a TSP has the most direct control since the conversion decision is theirs to make in whatever amount, whenever they choose. And for someone on SSDI, the calculation is different again. SSDI isn't taxed the same way as ordinary income, and a large Roth conversion in a given year could interact with other income test D benefits, which is a separate rule entirely, worth checking on its own before treating the latter as automatically safe. Here's the part almost nobody catches, and it's the reason this whole strategy trips people up, even when they think they've done the math right. IRMAA doesn't look at this year's income. It looks back 2 years. The premium you pay in 2026 is based on the tax return you filed for 2024. That means a decision you make today doesn't show up as a cost or a savings until 2 years from now on a premium notice that arrives with no explanation of why it changed. This is why so many retirees get blindsided in the opposite direction, too. They retire, their income drops, and they assume their Medicare premium will drop with it right away. It won't. Not for 2 years, because the government is still looking at the higher earning year they just left. Conversely, if you do a large Roth conversion this year to get it over with, the surcharge doesn't hit your wallet until 2 years from now, often after you've forgotten you made the decision, and it can catch you off guard if you didn't plan the following year's income around absorbing it. There's also a formal appeal process, Form SSA 44, for retirees whose income dropped due to a specific life-changing event, like retirement itself, which can reset the 2-year lookback early, but it only applies to certain triggering events, not to a Roth conversion you chose to make voluntarily. So the fix isn't convert everything now, and it isn't never convert. It's building the ladder deliberately. Check your MAGI room against the current threshold every single year, size that year's conversion or withdrawal to stay under the line, and treat the 2-year look back as part of the plan, not a surprise. Retirees who do this in small, repeated steps across their gap years can move a large traditional balance into Roth without ever tripping a single IRMAA tier, while retirees who wait and let the IRS force one giant RMD at 73 often cross 2 or 3 tiers in a single year. Here's exactly where to check your own numbers. Pull your MAGI from line 11 of your most recent Form 1040. That's your adjusted gross income. And add back any tax-exempt interest from municipal bonds. Compare that number to the current year IRMAA thresholds published on Medicare.gov's costs section, which SSA updates annually. If you're within about $15,000 to $20,000 of a threshold and you're still in your gap years before RMDs, that's the range where a small, deliberate conversion is worth running past a tax preparer before you act. Every year you don't check where you sit against that line is a year you might be one uncontrolled withdrawal away from a surcharge that follows you for 12 months. I'm not a financial advisor. I research the rules so you don't have to dig through agency tables yourself. If this saved you a search, subscribing helps this keep reaching the people it's built for.